why would you say non-banks, perhaps like Falcon, are well suited to filling this inventory gap?
Regulatory reasons why banks can't own inventory, whereas non-banks can. So we're not precluded to, but it goes actually beyond that.
How do corporates benefit from inventory finance?
So the main benefits to corporates' inventory finance are threefold. First and foremost is cost saving.
Welcome to Trade Finance Talks, your go-to trade, treasury and payments podcast, brought to you by TFG. My name is Dipesh Patel, editor at Trade Finance Global. It's nearly Christmas time. Warehouses are piling up, so what a good excuse to talk about the rise of inventory finance, something that we think is going to be an exciting area of growth for the industry in 2025. I'm delighted to be joined today by Sean Edwards, Chairman of the International Trade and Forfeiting Association, and Diresh Dabe, Chief Legal Officer and Head of Structuring at Falcon Group. Today we're talking about inventory finance. So let's just get stuck straight into the question. Diresh, for our listeners, can you explain please what inventory finance is?
Thanks, Dipesh, and pleasure to be here today. Inventory finance is a generic term given to products available to corporates to fund their inventory. Problem is that there's a whole suite of solutions available to corporates for them to fund goods from their suppliers, payables essentially, supply chain finance, and to finance goods once they've sold them, receivables finance, invoice discounting. It's a bit in between. What can they use to finance inventory, be it raw material in the production or goods when they've made them? And that's what I call the inventory gap. And essentially, inventory finance is the name for tools available for them to serve that inventory gap. And there's a whole range, from the simplest end being the typical loans or repos to the other end of the spectrum, which is bespoke solutions where someone like Falcon would slip onto your supply chain and own goods when you need them.
With regards to this inventory gap, Sean, is that why demand for inventory solutions soared in recent years? I know something we talk about more and more in the trade finance community.
There's two things here. Firstly, corporates had to get much cleverer about balance sheet optimization. And this is, as Diresh was saying, this is like the gap. This is the last thing that was missing. You've got payables, you've got receivables. You didn't have that bit of the supply chain finance puzzle that needed to be monetized, that needed to be properly banked. That was the first thing. It's especially with the changes in the accounting rules. There are many more benefits to getting that bit of it right. The other thing, of course, is that the physical supply chain, what's interesting here is we're talking about where the financial meets the physical, but don't forget the physical. This is all about owning real stuff that you need as a corporate to make your products. With the supply chain problems that the world has been experiencing recently, the move to nearshoring, friendshoring, onshoring, that manufacturing corporates are much more careful about. So they find they need more inventory to make their products. They can't rely on the just-in-time long supply chains for various reasons that, we all know, but they need to finance that increased hit to their balance sheet. So that's why I think it's been a lot more important. And certainly in my other role as a banker, I see a lot more demand from our clients.
Sean, you mentioned the physical supply chain marrying up with the financial supply chain. That means that there are quite a few operational challenges, perhaps regulatory challenges that do make it difficult for banks to offer inventory finance at scale. Is that right? And how can non-banks perhaps help to address that gap?
It is right. The main problem for banks, there's two problems. Firstly, there are legal/regulatory issues about banks being able to own inventory in various jurisdictions. They can't do that, so they need to find an intermediate to do that. The other thing is just much more prosaically, of course, you have somebody who needs to understand and manage that physical commodity. That's not something banks are very good at doing. I remember years ago having to take possession of a warehouse full of cocoa beans. That was not a happy experience. So banks are not very good at doing that. They would need to bring in other experts to do it. Much better that all of that practical management is dealt with by an intermediate. And as I say, in many cases, the banks can't do it anyway for legal reasons.
Thank you very much. And well, to be honest, I would be quite happy to have a warehouse full of cocoa beans myself. Diresh, is the answer the non-banks? Why would you say non-banks, perhaps like Falcon, are well suited to filling this inventory gap?
So Dipesh, as Sean alluded to, regulatory reasons why banks can't own inventory, whereas non-banks can. So we're not precluded to, but it goes actually beyond that. It's the operational burden which Sean touched on. When you're stepping into a client's supply chain, the risk to them of you not performing is that the entire manufacturing chain goes down. If you don't perform properly, they don't get the parts they need to sell their own product. So the upside is phenomenal, but the downside is great as well. So they really need a trusted partner who can handle the operational demands of putting up an inventory solution. So to give you an example, for one of our large clients, so far we've dealt with over 2,500 POs of 300 different unique product types, billions in dollars. All it takes is for one of those to go wrong, and our customer's supply chain is in jeopardy. Essentially, that need to be a trading company and own inventory, develop that expertise in buying, managing, operating goods and a supply chain is what makes non-banks well suited for the role.
Diresh, how do corporates benefit from inventory finance? And also, what types of corporates or industries would you say are most active in the area of inventory finance? And why do you think this is so? Is it to do with the complexity of their supply chains?
So the main benefits to corporates' inventory finance are threefold. First and foremost is cost saving. What we're seeing with corporates who've had inventory programs now, they've realized the cost saving they can make by using them to, for example, bulk buy from their suppliers. Essentially, they've discovered that inventory is floating somewhere in their supply chain. And if it's not with them, they're paying for it because their supplier is charging them more for holding the inventory. So by utilizing an inventory solution, it's far more cost effective for them. The cost saving more than make up for the cost of putting the program in place. Secondly, it's the resilience. And that was what really pushed inventory solutions into the spotlight post-COVID. Every major corporate at boardroom level decided that going to China to get their goods from the cheapest place possible was no longer the most sensible move when there's supply chain disruption. And so everyone is talking about what level of buffer inventory do they have to ensure that if they're missing a part, the factory line doesn't stop. And everyone remembers those headlines. Thirdly, it's balance sheet optimization. It's ability to have the inventory when you need it without having to own it or take on more debt. In terms of the corporates or industries that are most active in this area, the first out the gate were the tech industry. And I think that's no surprise because they're as innovative in their supply chain as they are in their products. And they've got very long supply chains with contract manufacturers who each do their own little job, but they're also very sensitive to cost pressures and working capital pressures. As their end customers were putting more pressure on them to hold more inventory, if you take, for example, Tesla told all their suppliers that they have to hold double the amount of inventory and they doubled their forecast. So each individual supplier, Tesla, had to hold 4 times as much inventory overnight. That's just not their business. They can't cope with tying up that cash. And other corporates essentially brought in inventory partners to support their suppliers. Similarly, in the automotive space, long supply chains, lots of individual contract manufacturers facing pressure. But now what we've actually seen is that all corporates across a range of industries who hold inventory for any extended period are seeing the benefits of an inventory solution. We just closed a deal for a commodities client who has to age their goods for over a year. No point in them holding on to that or owning it for those 12 months. So they brought us in to do so. Frankly, any client that has any meaningful amount of goods on the high seas as they travel from one side of the world to the other, there's zero benefit in them holding it while it's there. And we essentially become a supplier with better terms. Instead of them buying it FOB from port of departure, they buy DAP at port of arrival.
Hey, enjoying this podcast? Hit that follow button for more. Done? Let's get back to it. Thank you very much. So clear benefits from a risk mitigation and a balance sheet perspective. Sean, what structures do banks use to participate in inventory finance deals, such as participation agreements or perhaps payables finance models?
I think this is where sort of the interface between the physical and the financial really becomes very apparent. And actually, it's a little bit of a Frankenstein in some ways, if I'm honest, because actually what banks are trying to do is to get something that looks very much like a payables solution, reverse factoring or supply chain finance solution. But of course, as we've just discussed, the underlying problem that we're trying to solve here is the ownership of inventory and the operational issues about managing that and dealing with that, which are dealt with by the intermediary for the banks. But the banks really want to have something that looks unimaginatively, they want to have something that looks a lot like a classic payables solution. Certainly some of the stuff that we've been talking about with Falcon involves there being essentially a take or pay contract with the corporate. So that's an irrevocable obligation to take those goods by the end of a certain period. There are certain issues that we have to deal with, the management of drawdowns, because it's not going to be linear like a loan would be. You have to deal with those. But essentially what the bank is looking for is, as it is in most things of supply chain finance, it's looking for an irrevocable undertaking to pay. And this is how a lot of the deals are structured, because that is what banks really are looking for, actually, just the unconditional obligation to pay.
Thank you very much, Sean. Other than that irrevocable condition to pay, Diresh, what should corporates think about when considering these inventory finance solutions?
The counterparty, the inventory partner they're working with, fundamentally, because the longest pole in the tent in trying to get an inventory solution off the ground is getting the accounting right. Otherwise, you essentially end up with a very expensive loan. And therefore, your counterparty really needs to walk the walk and talk the talk of being a supplier and a trading company. If it isn't, essentially, it's just a waste of time. So the counterparty, their operational capability, to what we touched on earlier, to make sure essentially that if you let them into your supply chain, they don't jeopardize it for you. They have the expertise and the capabilities to deal with your processing that you need for your inventory on a real-time daily basis. And then finally, I would say is a track record of your counterparty in developing scalable solutions. It's all well and good doing small programs here or there and having a lot of PR around it. Inventory programs don't really move the needle for large companies unless they're a large number. And therefore, counterparties got a track record in doing large-scaled solutions over an extended period of audit cycles without any hiccups. That's who you want to trust with your supply chain.
Thanks, Diresh. I mean, you mentioned the PR there. Obviously, question to Sean here, but we saw Santander launch a JV with Pemberton just last week, I think, specializing in inventory finance. What do you see as the future of inventory finance for trade? Will it continue to grow, or are there significant challenges ahead? And how do we scale the uptake of inventory finance?
Yeah, it's a good question because for banks, it's a relatively new area of supply chain finance. I think it does need, as we've discussed at some length, it does need a partner for the banks to take care of all those operational risks. Frankly, I'm seeing being scaled very much at the moment now. You've got great partners like Falcon Group. You've mentioned Pemberton and what they're trying to do, again, with a partner. And the needs of the corporates are going to vary. If there's sufficient inventory or sales go down, then the need for these solutions is also going to ratchet down. It's a slightly unpredictable business. I think banks do want to have this as part of their arsenal. The bank that I work for and a lot of the banks who are members of it are all looking for a solution. It is not, I think, going to be the main part of their business. It's always going to be payables and receivables. But as I've said, when you structure a lot of these deals, inventory deals, you are trying to make it like a payable solution. So from that point of view, if you've got a great structure in place and you've got a good partner, then I think there's certainly more scope for scaling up. I think we are at the infancy of this so far as banks are concerned. The fact that you've got to have a third party helping you out obviously makes things a little bit more difficult. From a due diligence point of view, you have to know your partner, trust your partner. There aren't that many people who specialize in this area. So I think there are a number of issues to scaling it up, but the need is there. Otherwise, the community wouldn't be looking for solutions.
So I've got a slightly contrasting view to Sean on the demand for inventory solutions in this particular market. It's a huge market. It's a $3 trillion market. As Sean says, it's still very much its infancy. Given that the interest in it has been driven by supply chain disruption, I'm sure you'll agree in current times, the only thing that is certain is uncertainty when it comes to global trade. A solution to ensure that you have the inventory when you need it, it's something which clients or corporates cannot afford to not have in their toolkit. It's essentially an insurance policy to ensure that they can continue manufacturing and doing their business. So I think the demand for it, like insurance policies, will continue to grow. The awareness of it is definitely rising, and as more and more players enter the market, then it raises awareness even more. And that's why we at Falcon think competition is great, because the more transactions that happen, the more solutions in place, the more people become aware of it, the more others look at it. I do think over time, there will be some normalization, both in terms of structure, as Sean said, because banks are essentially looking for something which they can fund similar to supply chain finance. And so structures which fall outside of that and then don't give the banks the comfort they need because they're just too risky, I think will naturally fall away. So you'll see structures being normalized to something which is scalable. As I mentioned, scale is important. And I think also there'll be a bit of a natural selection in terms of the inventory partners in the market, because what I touched on earlier is just the hurdles to get across, both from an operational burden and an accounting burden, only going one way. They're only getting higher and harder. For those who can't meet those requirements, I think will naturally just filter out of the market. For now, the market is huge and there's more than enough for lots of different players to play in. And I think the demand will continue because, as we just seen over the weekend from geopolitics, the only thing that is certain is uncertainty.
Thank you very much. An interesting conversation to have this close to Christmas, where I'm sure warehouses are around the world filling up and goods need to get from A to B. So that was Sean Edwards, chairman of the International Trade and Forfeiting Association, and Diresh Dave at Falcon Group. Thank you very much both for joining us, and see you soon.
Thank you very much.
Thank you very much.